Hello there, this is Bruce at Fleet Capital Management. It's Friday afternoon at the 10th of May, 2024, and we're going to take a quick look at some of the market conditions, but most of this video is going to be talking about a new investment that's available and also a change to our fee structure at FCM. So let's jump right in. We always need to say the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. I'm always available, Bruce at Fleet Capital Management. Our website is fleetcapitalmanagement.com. This button on the bottom will take you to our most recent videos, and this button will show you my calendar so we can schedule a one-on-one and have a conversation about your account or the markets or anything that you would like to talk about. I'm going to come back here. I'm going to start with the matrix, which is updated through today. And you will see that where we had neutrals over here, we have now gone back up to green. So on our group one, which is our shortest term or group that is looking for the best returns, we're now in an up situation. Group two is a little bit more conservative than group one. I'll be going over that again in a minute, is in an up situation. Our moving averages have gone from a pullback, which is this color here, this mustard color, back to a full bullish configuration where the 8-day is above the 20, the 20-day is above the 50 day is above the 200. Those are all moving averages. Our bear market avoidance indicator, which I would suggest is one of our most important indicators that I've created, has been in the green. We are not in a bear market. This is either green or red. There's no in between. The VIX, which is the volatility or fear index, remember, if it's 17 or below, it's green. If it's 17.1, I guess, to 20, it's yellow. And if it's over 20, it's red. We did go into the yellow caution area. This might be a caution area too, but we are now well below that, so we don't need to worry. The IBD exposure has maintained a 3. My guess is by Monday or Tuesday, if we have any positive market action, that will go up to 4, and 4 and 5 are kind of, they're bullish, they're most bullish. I don't use this to trade on. I just use this as a guide because IBD is excellent, but these are my indicators and they are all back in the green. Okay, so let's go back over here. And what we're going to talk about now is a new no-risk investment option that is now available. So many of you have participated in defined outcome ETFs with me. I'm going to talk about that, and I'm going to show you the differences between this new one and the buffered. So just bear with me. This new one is by a company called Calamos Investments. They're out of Naperville, Illinois, which is just outside of Chicago. I've worked with this company for 30 plus years. I know them very well. I've been to their offices outside of Chicago, so this is nothing new. This structure that they have put together is new, and it's very interesting. I'll say that it's going to be based on the S&P 500 or the NASDAQ or the Russell 2000. Right now, they have an S&P out. They're bringing the NASDAQ and the Russell out shortly. This is called a structured protection ETF, which means it has upside to a cap and it has no downside risk. They have 100% of their downside. Let's see if this will work. They have 100% of the downside protected. So there is absolutely no risk to the downside over a 1-year outcome period. And the innovator defined outcome ETFs were also 1 year. So we're just looking at 1-year investments. The guarantees only come in on the last day, which is the date of maturity, but they're liquid to the day. So if we're up and we need to raise some cash for you, we can always sell them. That's not a problem, but we wouldn't want to do that if the market was down. So it has 100% capital preservation. It does participate in the upsides of the market. And just like Innovator, it does have some tax benefits, or what we call alpha, which I will talk to you about in a minute. Okay, next slide. The way Calamos works is this lighter color blue is their ETF, and the darker colored blue is the market. It doesn't matter which market right now, but what they want to show you is there is an upside cap, which I will review with you in a minute, just like Innovator had an upside cap. And what does that mean? That means, let's say the upside cap was 12% and the market went up 15%. You couldn't go up 15%. You are capped at 12%. That's what the cap means. And what this is showing is over the 1 year period, if the market that it's tied to has a return less than the cap, then your investment, the Structured Protection ETF, should have virtually the same rate of return. So let's say, and again, I'm making up some numbers, let's say the cap is 10%. Let's say during the year, the S&P, we'll just use that as our example, was up 7%. Your investment should be up right about 7% as well. So that's if the market performs under the cap. If the market exceeds the cap, which you can see over here, you're capped at whatever that cap is. You can't make any more than that. So you could make less than the market does. But what you are giving up in added upside is, let's go over here. Let's say the market is in a correction and is down whatever amount, 5%, 10%, 15%, 20%, you're down 0% because these have no loss. If we went into a bear market, which the market could be down 25%, 30%, 40%, 50% is possible, you would be down 0%. So you give up some of the upside in order to have no risk on the downside. Okay. In 2023, this might help visualize it a little bit better. Where you see 100, that's the starting value. Let's just call that $100. Okay. So that line right across here is where we started, the beginning of this 1 year investment. And this dark line right under the 110, that dark line is the cap. It was about 9.8%. So that's the cap. You cannot make more than that. This light gray line is the movement of the S&P 500. That's actual because this was last year. And you can see how volatile it can be. The dark blue line is the performance, the daily performance of the structured investment that we're talking about. And you can see how much smoother it is. It just sort of heads from bottom left to top right. This had a little bit of volatility in here. One of the most important things on this chart to understand is the last month of the investment. They're always a year. The last month to 6 weeks of the investment is where kind of the rubber meets the road. And you can see it went in that last month, it went right up to its cap. Now, the S&P was up significantly last year. The S&P does not have to be up this much in order for you to achieve your cap. The cap was just under 10%. The market would have had to have been up, let's say, 11.5% for you to achieve your full cap. And remember, it happens towards the end. It could happen, it could happen earlier, but for the most part, let's just say it happens toward the end. So on this chart, look at this volatility. Stock market ran up, ran right back down, ran up big, and then we had this pretty significant correction going into November, and then we had a huge run up. In this investment, it dampens the volatility dramatically. So that's 2023. This was 2008, which was a terrible year. That was the global financial crisis. And 100%, this is an example. This wasn't even out at that time, but this is an example. Their computers were able to look at the daily price movements of the S&P and calculate what the price movements of the investment would have been. This is the cap up here. This is what the cap would have been, okay? The dark blue line is the investment itself. This dashed line is the actual performance of the S&P 500. It dropped about, well, significantly. It dropped almost 40% at that time. So the point is, even in a dramatic downturn in the market, we had that in 2008, we had that in 2022 bear market, look at what happened to the price of the investment itself. Let me just get rid of some of this. It basically stayed flat. So you did not make any money in 2008 if you held this investment, but that's not why you bought it. You bought it so that you didn't lose 38% of your investment. That's why you buy it. Okay, I hope that's starting to kind of make sense. And then I'm going to show you the differences between some of these new investments and the innovator defined outcome. One more, in 2017, we saw, 2007, we saw a very, very volatile S&P 500. It was sideways, but it was very, very volatile. And you can see that only one time for maybe a week did the investment itself dip down below zero, but that doesn't matter because you have a 100% guarantee. And at the end, remember I said the last month is where the S&P and the investment kind of come together. See how they're tracking almost perfectly together. So the investment would have generated a return that is very similar to the S&P 500 because it didn't go up to its cap. Okay. Again, I hope that makes sense. Now, with that outline, let's look at some differences. And I'm gonna call these different types of protection. So and this is all the May series that came out May 1st. So these are very, very current. These first two are from the company Innovator. These are the defined outcome ETFs. And they have one called the Buffer, which buffers or has protection down 9%. So if the market went down 9% and it was down 9% exactly on the maturity date, you lost nothing because you are buffered for the first 9%. But if the market went down 15% and was down 15% on that maturity date, that's the only day that we really care about. The market's down 15%, you would have been down 6%, the difference between 9 and 15. So the May buffer had an upside cap of 18.21% and downside protection of 9%. They also have one called the power buffer. That cap, the upside, was 14.3%, less than the regular buffer because it's giving you more downside protection. You were protected down 15%. But if, like in 2022, the bear market, if the market was down, let's just call it 30%, you would have been down 15% because it would have protected the first 15%. But anything after the buffer protection is your loss. That's how it works. Okay. The May Calamos product that I've just been talking about had an upside cap of 9.81%. You can see it's lower still, but it had protection of 100%. It cost these companies money to buy the protection. That's why you lose some of the upside available profits to you, if you will. So again, if you wanted the highest upside cap and you were okay with a 9% downside protection, even if the market went down 20%, instead of being down 20, you would have been down 11. Then this would be a good investment for you. If you wanted a little bit more downside protection, down to 15%, you would get a little lower cap. But again, if the market went down 20% on that last day, you would be down 5 because you would be protected the first 15. But anything after 15, anything after 9 is your loss. With Calamos, again, a little lower upside, but 100% protection. So that's the main difference in these types of investment products. If you are a person who says, I don't want any loss, well, then your options are to go into a money market account or a CD or a treasury bill. And let's say in a treasury right this minute, you could get about 4.7%. I think that's probably realistic for a one-year treasury. you could do that and you would have 100% protection, but you couldn't make more than what the Treasury is paying. With this type of investment, you have the ability to make considerably more, almost twice, and still have the same 100% downside protection. So that's who this is for. This is for the person that says, I just want to use treasuries because I want no risk. Now, if you're fine with 4.5% rate of return, and you can't make any more, then a treasury is perfect. A treasury is great. If you're hoping to make a little more to stay ahead of inflation, then this is another type of investment that you can use. The downside, comparing this last investment to a treasury, the upside is your potential to make, let's say, twice what a treasury is paying. The downside is if the market goes down in that year, you will make zero. But in the treasury, you may have made 4.5%, whatever your interest rate was. So there's trade-offs to everything. There's pros and cons to everything. I think that because the markets are usually higher, 2 out of every 3 years, I think this is a much better investment with a higher probability of outperformance over treasuries. But these are the differences. Now, these caps are set every time a new series comes out. So every month when a new series comes out. What causes these caps to change? Because one year this cap may be 16% instead of 18, or it might be 20% instead of 18. These caps in part are tied to interest rates and tied to what the markets perceive will be the outcome 12 months from now. So it's a fairly complex computation. It's easier just to think of it that they are tied to interest rates. The higher the interest rates, the higher the caps. If interest rates went down to zero, these caps would be much lower. But if interest rates went down to zero, what are you going to get on a treasury? 0.5%, 1%. So this cap might be 5 or 6%. So generally speaking, even the most conservative cap is always, I can't imagine a scenario where it wouldn't be at least 2 to 3 times higher than what the treasury is. So I know I went through that quickly, but I wanted you to understand that Calamos is the new one. It has 100% protection. Let's go back to the bear market of 2022 for a second. I got a lot of emails, which is fine. That's what I do, in saying, hey, I thought you said I was protected. And for the people that had investments in this. And I had to explain and re-explain, your protection comes on the last day, the date of maturity, and it's only to a certain level. Like in this one, it was only protecting 9%. So if the market's down 20%, which it was down more than that, you would still have an 11% loss on that last day. And these get kind of hard to understand sometimes. They really are. This isn't. If you have this in your portfolio and we go into another bear market like 2022, which I hope isn't for a long time, then you may see that this is your investment's down 20%, and I just have to remind you, no. On data maturity, you're down zero. It's just 100% protection. But during that time, you'll see it move, but it's 100% protection. Okay, so that's the difference. If you have questions about this after watching this video, shoot me an email or hop on my Zoom calendar and let's talk about it. Okay, now with that, I have decided to revise our fee schedule. So let me show that to you now. So this is our new fee structure going into place as of June 1st. So what's that, 3 weeks from now? Group 1 and 2 accounts are charged a 1% fee, and that is not changing. Group 1 and 2 are very, very similar in a normal bull market. But if the market gets tough, if we go into a bear market or things aren't just normal plodding along, Group 2 has less exposure to risk than Group 1. Okay, what investment choices do you have as a group 1 or 2 account? Everything that's available under the sun. You have everything. There are no restrictions. Your risk management comes from the risk management that I do with markets and stops and all the analysis that I do every day in the market. And that's where your active risk management comes from. Group 3, prior to June 1st coming up, was also being charged 1%. I've decided to reduce that fee to 0.75%. And if you are currently a Group 3 client who was paying 1%, I've already made the adjustment. It will go into effect on June 1st, and you have just saved 25% of your fee, or 25 basis points. What investment choices do you have as a Group 3 account? Well, up to 25% of your allocation can be in market ETFs. It can be in the S&P and the NASDAQ if you want. It can be in all kinds of ETFs. I've got some more conservative ETFs. Those are the low risk. So up to 25% of your allocation of your account can be in those ETFs. You can do up to 75% in treasuries. That's where we get the 100% here. Or of that 75%, you may choose to use some of those defined outcome ETFs that I've talked about, or some of the lower risk market ETFs. So don't worry if this is just a little bit confusing. The reality is you've got options. You can use treasuries, you can use CDs, you can use defined outcome ETFs, but only up to 25% of the allocation can be in full-on market ETFs that are tied to the S&P 500 or the NASDAQ. What is your risk style? Well, it's very blended, and it's definitely lower risk, because whatever percentage you choose to put into treasuries, let's say you have 50% in treasuries, well, that has no risk. And let's say you put 25% in some very low risk or defined outcome ETFs. Well, there you have lower risk, but some risk, but it's managed. You have some buffers. So it's a blended level of risk. There's now a Group 4. Group 4, their fee will be 0.5%. What investment choices are available? 100% has to be in either defined outcome ETFs, like what we just talked about, including Calamos, that has, again, defined outcome ETFs either have a 9% downside or a 15% downside protection, or now a 100% downside protection. I can buy treasuries in Group 4 or CDs or anything like that. The reality is, someone who is in Group 4 really wants zero risk. So they're probably going to use, I'm going to keep hunting for different yields that I can find on treasuries and on CDs around the country. And we're probably going to use the Calamos, which is 100% downside protected. So Group 4, my best guess is that's how they're going to be allocated. It's all going to be 100% risk-free. That's what I put over here. So the risk style here is either 100% risk-free, which is what I suspect it will be, and or some defined downside protection. And I will leave that up to the client. I'll show you exactly what's available, the caps and the downside, and together we'll look through it and make a decision together what would be best for your risk tolerance, if you will. But again, my guess is that Group 3 may use some defined outcome ETFs with those 9 or 15% downside buffers, and Group 4 will probably just use 100% risk-free. Okay? So there's nothing that you need to do. If you're already in Group 3, you're going to see your fee drop lower as of June 1st. And we now have Group 4, which I would just emphasize is 100% risk-free. So if you have reached a point in your life where you no longer are willing to accept any market risk, we now have some really interesting ways to generate return. You know, you might put 50% of your money in treasuries, let's say at 4.5%, and 50% of your money in the Calamos at almost 10%, 9.8%. And so you might get a blended rate, and up yours, you're going to get a blended rate greater than treasuries or CDs. So, but we'll go over that in much more detail. I hope this makes sense. If you have any questions, again, just shoot me an email or hop on my Zoom. I also want to tell you, even if you are not someone who is at a point in your life where you're really interested in 100% risk-free, you want to get a higher rate of return or the market type of rate of return, which can be very significant, but it's also a little more volatile. If this is not you, you may know someone in your family or your circle of friends who is absolutely risk adverse, but now they have the potential to get a much higher rate of return, double, I would say, than what a treasury could offer. So what I'll say with that is, please feel free to share this video. If you know someone, like I said, family or friend or acquaintance that you think would benefit from this, please let them know. Feel free just to forward the email. And the reason I bring that up is, remember, at the end of this year of 2024, the reality is we're probably not going to accept any new clients. Now, once in a while, a client passes, which is always sad. And as a business, we try to open it up to where we can keep the business stable. So we may open it up once in a while for a week or two to possibly accept a new client. But for the most part, we are not going to accept new clients, okay? So please let people know, because there are people out there who are no risk investors, and this is a phenomenal investment, can be a phenomenal investment for them. Okay, so that's what I wanted to show you. I know I ran through a lot. I'm not going to spend time today talking on about the market. Here's the S&P 500. I'll just show you, this is what I was saying. There's the 8-day, the 20-day, the 50-day, the 200-day. We are back up into the green, so we're in a fully bullish technical setup. And I won't spend any more time because I don't want this video to be too long. Things are looking really good across here. My guess is this is going to go into the green again next week from IBD, and then we'll have just green across the board. And that's a story. So a lot of information. I'm excited about it. I hope this was worth your time. Let me know if you have any questions. Let me know if there's anyone you need me to talk to help explain this. I'm always willing to do that. And that's a story. So have a wonderful weekend. I hope this made sense. I hope it was worth your time. And I will talk to you soon. Bye-bye.